Good afternoon, class, or good evening. So you're welcome again to another class on financial reporting. Can remember vividly that last week, Sunday, we started financial instruments, and I explained the background to you that they are majorly debt instruments and equity instruments. And they are both debt and equity instruments. I told you they are instruments that are used to borrow money. Of course, for debt, for equity, you don't use it to borrow money, but you use it to raise capital, whereby the investor becomes your shareholder. And I made you understand that everything we want to teach you in this topic is majorly around accounting for this debt and equity instruments. And in order to do that accounting, so we are going to use two accounting standards, which are IAS 32 on financial instrument presentation, as well as IFRS 9 on financial instruments recognition and measurement. So these two standards we shall utilize to do that. So we started with IAS 32. So I told you that IAS 32 will teach us three things to help us with definitions of key terminologies, and also to help us with how to classify and present financial instruments into debt and equity instruments, and also compound financial instruments as well. So we started with the definitions. You need to understand that financial instrument is any contract that gives rise to financial assets of one entity and financial liability or equity instrument of another entity. We explained that in details. We also went on to financial assets. We explained it. We went to financial liability. We went to equity instrument. We explained all of that. And I went to how do you then present a financial instrument as either debt, that is financial liability, or equity. I used scenarios for that. We started with this, and each of you participated in this question where we're able to identify what net worth has, whether a financial asset or a financial liability, and also whether a financial instrument exists. And we also use this past question. This is a November 2024 past question. It was the question 6 for that die for 15 marks. We also looked at this question, we analyzed it. We wrote a memo explaining how to treat each of these transactions to the senior accountant. And we were writing it together, and I was showing you how my thought process was actually moving together. So basically, that was what we did last week. And I'm sure I gave you assignment, which I know for a fact now that most of you did not do. Okay? I mean, the reason is left to you. Now, today, we are going to be moving to another part of this topic, which is governed by IFRS 9 majorly. Even though I'm not done with IAS 32, I'm still coming back to compound financial instruments in IAS 32, but you need some knowledge here to appreciate that part. So let me just clear this one. Then I go back to that other guy there. So what are we looking at here? Under recognition and the recognition, not of financial assets, but financial instruments. So starting with recognition of financial instruments. The financial instruments are recognized when an entity becomes a party to the contract. So as soon as an entity becomes a party to a contract, then we can go ahead and recognize that financial instrument in the books when you become a party to the contract. And an entity can become a party to a contract either at the date of agreement or the date of commitment. So an entity can become a party to a contract either at the date of agreement or the date of commitment. So the date of agreement is the date they signed the contract. The date of commitment is the date probably maybe when you invested or when you collected money. That's the date of commitment. So either one that is coming earlier is the date you become a party. And as soon as you become a party, then recognize it, incorporate it in your books. The one that is financial assets, recognize it as financial asset. The one that is financial liability, the one that is equity, like that. Those are the items we have. So that's recognition of financial instruments. The second one here is the recognition of financial assets. And when we say derecognition, it's like the opposite of recognition, and it's simply the removal of a financial asset from the books. And you see, financial assets can be recognized, can be derecognized, when the following conditions occur. When the following conditions exist. Number one, the contractual rights to the cash flows has expired. Number two, there's a transfer of substantial risk and reward. There's a transfer of substantial risk and reward. So you derecognize your financial assets when any of this condition exists. Not any, the two of them must exist. It's either the contractual right to the cash flows has expired, or there is a transfer of substantial risk and reward. And when we say contractual right to the cash flows, it simply means that the money you're expecting, you have collected everything. Or the time has elapsed that you can no longer collect any money. So cash flows has expired. You are not collecting any money again. Then you recognize it. And not only that, there's a transfer of substantial risk and reward. Let me say attributable to the financial asset. So when there's a transfer of substantial risk and reward attributable to the financial asset, then you can recognize your financial assets as well. So these two conditions must exist before you can recognize. And when we say transfer of substantial risk and reward, what does that mean? It can mean two things, right? Number one, it could be when there is an unconditional sale, when there is an unconditional sale of the financial asset, that can signify transfer of substantial risk and reward. And number two is when there is a sale of a financial asset with, with a repurchase option at fair value. So when there is a transfer of a financial asset with a repurchase option at fair value, we can say that you have transferred substantial risk and reward, right? So this first one is clear. It means that you have sold the financial asset. The second one, you sold, but you told the buyer that, okay, I can buy it back, I can repurchase it, but it's going to be at fair value. That's still okay because you are repurchasing at fair value, which means that that's totally different from the sale you have made. They are different transactions, and the focus is the sale right now. So you have sold, but if the repurchase option is at a fixed price, they have not sold, meaning that we can't distinguish the two. They are the same. So if you sold, you're now saying you buy it back at this price, at a fixed price. What's the basis of the price? We cannot work with that. Okay, we believe it's not objective enough to say that we want to separate it from the selling itself, and we believe they are the same. So you have not actually sold, but here you have sold when you sell, and you can repurchase at fair value. So they are different. So we focus on the sale that you have actually made. Okay, so that's for the recognition of a financial liability, a financial asset. Then the recognition of financial liabilities. So financial liabilities can be derecognized, when the obligation in the contract has been extinguished. So financial liabilities can be derecognized when the obligation in the contract has been extinguished, which means that is the obligation is either transferred, cancelled, or discharged. Transferred, cancelled, or discharged. Either of them shows that the obligation has been extinguished. Then you can derecognize your financial liability if any of them exists, because that's what we call extinguished. So that's it around recognition and derecognition. Now let's look at this question for this. Okay, who is reading this one for us?
Good evening, sir.
Femi, how are you doing?
Hi, sir.
Okay, let's get to it.
Okay. XYZ Bank hold a portfolio of trade receivable amounting to 5 million naira. To improve its liquidity, the bank entered into an agreement with ABC investors, selling the receivable for 4.8 million naira under the term of agreement. Agreement number one, XYZ Bank transferred the legal right to receive cash flow from the receivable to ABC investors. Number two, however, XYZ Bank provides a guarantee to ABC investor that if any of the receivable becomes uncollectible, XYZ Bank will compensate ABC investor for the loss. Number three, the bank retained the right to repurchase specific receivable under certain conditions. You are then required, based on IFRS 9 financial instrument, should XYZ Bank derecognize the trade receivable from its financial statements? Justify your answer by evaluating whether the risks and reward of ownership have been transferred.
Thank you. So if you look at the requirements of this question, we're told that based on IFRS 9 financial instruments, should SYZ Bank derecognize the trade receivables from its financial statements? Justify your answer by evaluating whether the risk and reward of ownership have been transferred. So how do we solve this? If you look at the question, they said this bank has a trade receivables of 5 million. So it needs money, it wants to improve its liquidity. So he's entered into an agreement with an investor to sell that receivables for 4.8 million. So he collected money. So those investors will like be making a gain of around 200,000. That's their own gain. Now, this is where the agreement that backs up that the other transactions. So number one, SYZ Bank transfers the legal rights to receive cash flows from the receivables. Number two, said, however, XYZ Bank provides a guarantee to ABC investors that if any receivable become uncollectible, XYZ Bank will compensate them and they can retain right to repurchase. Okay, so how do we do this? So number one is this. First, you say financial assets can be derecognized when the following condition exists. Number one, contractual right to the cash flow has expired. Number two, there is a transfer of substantial risk and reward. That's where we start. You now say, form the question. The contractual rights to the cash flows, the cash flows has expired because the bank has transferred its legal rights to receive cash flows, which is this one. So they have transferred their legal right to receive cash flows. Number two, additionally, no, however, XYZ Bank, or let me know, the bank will, or as the bank has made commitments to compensate the investors for any loss. This signifies that the bank retains substantial credit risk. I mean, since they said if the receivable does not pay, they will compensate them. That means you still retain credit risk. Therefore, the bank has not transferred substantial risk, and it should not derecognize the trade receivable. So you cannot derecognize it, mainly because of that. Okay? Mainly because of he did not, he's still retaining risk. So there's no way he can say he wants to derecognize the trade receivables in this case. Okay, and that's the scenario here. So let's go to the next question. It's very similar to this one. So more assignments are coming. So let me not, I won't be saying the same thing. You can just review this, and it's not really compulsory though, because, okay, still on IFRS 9, let's proceed to measurements. Let's proceed to measurements straight on. So measurements is basically this financial asset you have recognized in your books. How much should you put them in your books? That's what measurement wants to look at. How much? How much are you going to put them in your books? So to do this, to do this, for financial instruments, you should know when I say financial instruments, is either I'm talking about equity instruments or I'm talking about financial assets, or I'm talking about financial liabilities. So this this is financial instruments. So how do we need to pick these one by one and measure them. So this ICAN didn't really talk about how you measure equity or share capital, because for share capital, it depends on the country itself. It depends on each country. So in Nigeria now, we have a way of measuring share capital as prescribed by CAMA. So here now it's CAMA that will guide us. So according to CAMA 2020, share capital or equity instruments, share capital are measured at nominal value. They are measured at nominal value. And do you know where this nominal, even though in the exam, they will always give you nominal value. They will always give you. But in real life, right, this nominal value can be determined from your CAC documents. Usually you're from 2, there's from 7, there's from 2. You'll find it on your CAC documents in real life. But in your exams, of course, they will give you the nominal value, because the way share capital is determined is just the number of shares times the nominal value. That's what goes into your share capital account. However, for financial assets, let me start with financial asset, then I can come back to financial liabilities later. Now, again, for financial assets, don't forget that there are three also. When you say financial assets, they are cash, they are equity instruments of another entity, and they are also contractual right to receive cash. So we need to pick this one by one as well. The first one, which is cash. How do you measure cash? Your cash is your cash. There is no special way for measuring cash. Cash, you know how much you have. That's your cash. And you measure it at that. So your cash is your cash. So no issue around that. Now, the major one is these two that we need to carefully look at. These other two that we need to carefully look at. So let me start with this one. Equity instrument of another entity. Let me call it equity investments. It's like equity investments. So, which is basically where an entity buys shares in another. So how do you usually account for that? How do you measure that? So for measurements, we will usually have initial measurements and subsequent measurements. So initial measurement is the measurement at the transaction date or at the date you'd acquire that investment. That's initial measurement at the date of acquisition. While subsequent measurement is the measurement at the reporting date or at the end. Okay, so at the date you acquire the investment, that's initial measurement. So initially, equity investment is measured at the transaction price. That is the amount invested, the amount paid for the investment. That's transaction price. How much did you pay? So the amount you pay for that investment, that is the transaction price. And that is how you measure shares when you acquire them. So it's as simple as you acquired shares for 10 million. That 10 million is the transaction price. Or you acquire shares for 5 million. That 5 million is the transaction price. So it's just how much you pay, the amount you pay for the investments. That's how much you would initially recognize that equity investment or shares that you bought. But IFRS 9, IFRS 9 requires that all equity investments must be classified at the date of acquisition. So IFRS 9 requires that when you buy these shares, you need to classify them. You have to classify them. So that we can understand, we can understand your intention for buying these shares. Okay, let me show you. How do we classify them? They are classified either at fair value through profit or loss, or at fair value through other comprehensive income. So I can shorten it as fair value to OCI, or I can have it as fair value to POL. So this is how we classify this equity investment at the date of acquisition. You need to classify it. And how do you know whether you are classifying either at fair value to POL or fair value to OCIs? Then that takes us to basis of classification. And the basis of our classification is based on whether the investment is held for trading or speculation, or it is held for the long term. So if the equity investment is held for trading, if the equity investment is held for trading or speculation, it will be classified at fair value to profit or loss. And you know that when we say held for trading or speculation or for the long or for the short term, it simply means that you have the intention of selling. Whether you're able to sell it within a year or after 1 year or after 2, that's another thing. The main thing for determination of held for trading is that you have the intention to sell. In that case, we would expect that you're going to classify the financial assets at fair value to profit or loss. But if the equity investment is held for the long term, then it will be classified at fair value to other comprehensive income. And when we say you are holding it for the long term, it means you don't plan to sell. I mean, like $10, for example, now, its acquisition of shares in First Bank is not to sell. He wants to be on the board. That's for the long time. He wants to be the chairman of the board, which he has anyways. So that one is holding it for the long term. So in such cases, you will use the fair value to OCI calculation. And all these are done at the beginning of the year. So, I mean, all I'm saying is this. I mean, when I say classify, I classify. So maybe, let's say an entity acquired equity shares or ordinary shares for, let's say, 10 million. Okay. It intends to sell within 1 year. So this is a candidate for fair value through P&L. So in our books, you just simply debit the financial assets, or you can call it equity investment, at fair value to POL. This is how you describe the account. So you don't just say equity investment. You will need to put at fair value to P&L. That's what we mean by classification. And you find it in mostly all accounts that do this. Of course, if they are paying money, public credit bank, but that's uh, that's the idea of that classification. Now, usually at the beginning of the year also, entity will incur transaction costs. So this is the amount paid to is, let's say, a stockbroker that helps you broker that transaction, stockbroker, or I mean that's is the professional fees of the stockbroker. Let me put it like that. So this is like the professional fees of the stockbroker, or it could be maybe stamp duties you have to pay to FIRS on that transaction, and maybe stock exchange fees, maybe they start some exchange fees. All of these are transaction costs. So how do you treat this? So you see, these transaction costs will be capitalized, that is, added to the financial assets if the asset is classified, as fair value, to other comprehensive income, but it will be expensed to POL if the financial assets is classified at fair value through profit or loss. Then you can then expense that transaction costs. So that has to be carefully noted. Okay, so all these are happening at the beginning of the year. Don't forget, we are still talking about equity investments. We went to initial measurements at transaction price. We said the standard requires that you classify it, which can be either classified at fair value through profit or loss, or fair value through other comprehensive income. And we said, how do you determine this classification? We said it depends on whether you are holding it for trading or speculation, or whether you are holding it for the long term. If you are holding it for speculation, then classify it at fair value through profit or loss. But if you are holding it for the long term, then classify it at fair value through OCI. So, and I showed you what I mean by that, by showing you this. Then I went to transaction costs, which is broker's fees, stock exchange fees, stamp duties, and all of that. And this transaction cost, I said it to be capitalized, that is added to the financial assets, added to the costs of the financial assets. If the asset is classified at fair value through OCI, then you capitalize the transaction cost. But to be expensed to POL if the financial asset is classified at fair value through profit or loss. And that's the very straightforward, right? Then at the end of the year, you will do subsequent measurements. So equity investments is subsequently measured measured either at fair value to other comprehensive income or fair value to profit or loss. So they are either measured at fair value to other comprehensive income or they are measured at fair value to profit or loss. So it's like it's very consistent with how it is classified. So the same way it's classified is the same way it's measured. And it's so consistent in such a way that if you classify a financial asset or equity investment at fair value through OCI, it is expected that you measure it at fair value through OCI. If you classify at fair value through POL, it is expected that you measure at the end of the year at fair value through POL. I mean, we expect such consistency in classification and in measurement as well. Very important for us. Okay. And you see, what does fair value to OCI, fair value to POL, what do they really mean? I will show you. But I mean, at a very high level, it simply means that when there are changes in fair value, because fair value of shares would keep changing, it will change. So when there are changes in fair value, that change, that gain, okay, you either recognize it to OCI or POL, depending on this measurement basis. If you're measuring it at fair value through OCI, it goes to show that any gain or loss at any time, any year, would be recognized to OCI. But if you're measuring it at fair value through POL, it means that any gain or loss that is made on this equity investment will be recognized to POL. That's just the distinction between the two. That's the distinction. It's not more than that. And that is all for equity investments. That's all. That's how to measure equity investments. Do we have any questions on that before we move to the next measurement basis, to the next item? Okay, good. So you understand everything. Let's move to the next action. So let's go to debt investments. That's also financial asset. We are still in financial assets, but now we're looking at debt investments. When this, where an entity has contractual rights to receive cash. So when an entity has contractual right to receive cash, that's debt. You must have done a debt investment. Then how do you measure this? How do you measure this? So let's go through what we have gone through again. First is initial measurements, which is the measurement at the date of acquisition. That's initial measurements. How do you do these measurements initially? So initially, debt investments, let me put initially, initially, debt investment is measured at its transaction price, similar to equity investments. That is, the amount invested. So basically, the amount you invested, that's how much you measure your debt investment. So it's as simple as the principal amount. It's as simple as you invested 100 million in government commercial paper, or government does not issue commercial paper, in commercial paper of Dangote, or in a government treasury bills, or in a corporate bond. You invested 50 million. The amount that you invested is the transaction price, and it is with that amount you would initially measure your debt investment. Now, again, IFRS 9 requires that an entity must classify the debt investment. So IFRS 9 requires that, okay, you need to classify these debt investments, and they are classified in either of the following ways. Number one, you can classify it at amortized cost. Number two, you can classify it at fair value through other comprehensive income. Three, you can classify it through at fair value through profits or loss. So these are the three classification of a debt investment. So how would you know how to classify it? Then that takes us to the basis of classification. So the basis of classification is based on two tests. We look at the business model test and the contractual cash flow test. The business model test and the contract. These two that can help you know how you classify a debt investment. So when we say business model test, what do we mean? You see, first is that this business model is how an entity makes money. I mean, if I want to make it very simple for you, every business has how it makes money. So your business model is how you make money as a business. How do you make money? Like banks now, they know how they make money. You know that they will help you keep your money, and they would lend that money to other parties that needs it. Anybody that needs that money, they will give it to them, and they will charge interest. So majorly they make money through interest. And now they are involving with technology where they help process transactions, transfers, and all of that. They are making fees from that as well, and a lot of other ways to which they are making money. And they also make foreign exchange margin and all of that. That's how they make money. So let's not spend too much time on that. Now we are talking about debt investment. So there are two ways to make money in debt investments. It could be you can either make money from interest income, and principal repayments. Okay. interest income and principal repayments, which is how most debts will make money. But, or it could be interest income and principal repayments plus selling of the financial asset, or selling, let me call it, to be consistent, the debt investments where there is an opportunity to make a higher yield elsewhere. So in the context of debt investment that we are talking about, these are the two ways you can make money. So is either you make money in the conventional way, collect interest, collect your principal, okay? Let me put it like that for you. Collect interest income and principal repayment, or you collect interest income and principal repayment plus also selling. That is, you also have the mind or intention of selling where you see an opportunity for a higher yield, meaning that if you invest in a commercial paper of Dangote that is giving you 12% per annum, you now saw that MTN also issued a commercial paper and they're ready to do 20%. And since these commercial paper are listed on FMDQ, so you can easily sell. So you just sell. You sell, you go and buy MTN, right? Just so that you can get an higher yield. Of course, they will know how to manage um, those trades in between. But that's how this second point works. Okay. So the second one, which talks about contractual cash flow characteristics. So this is saying that there must be a contract. There is a contract that supports how the company makes money, or let me call it the entity. So there has to be a contract that will say, okay, you're going to be earning this particular interest, and it is a tradable instrument like that. There has to be a contract that shows how the entity makes money. So in your exams, okay, for basis of classification, even though if they ask you basis of classification, you should tell them all this, right? But when you are using this when they want you to explain how you classify this, know that this one is no, they don't really test this contractual cash flow because it's like a default occurrence. There has to be a contract now. For it to even be a debt investment in the first place, there must be a contract, right? There has to be a contract. So it's always there. Just that the contract must be consistent with how you say you want to make money. The interest you are putting in your books, the contract must confirm the amount of interest. You should be able to confirm it. So using this basis of classification, then how do you then classify this thing? How does it help? So you classify a debt investment, you classify a debt investment at amortized costs where the business model is to collect solely interest income, and principal repayments, and there is a contract, that supports the business model. and there is a contract that supports the business model. So for debts, for amortized cost, I mean, it's this basis. Your business model is to collect interest and principal, and there is a contract that supports that business model. Secondly, you classify a debt investment at fair value to other comprehensive income where the business model is to collect interest income and principal repayments, as well as sell the debt investments where there's an opportunity to make higher yield. Okay, so that's the second classification. The third one, the classification as fair value through profit or loss is a default classification in the sense that an entity can decide, an entity can decide or make an election to designate all its debt investments at fair value through profit or loss. So this one is this third one, there is no basis whether you are collecting interest or whether you're selling. It does not affect fair value through profit or loss. It's a default classification in the sense that the entity can decide right from initial recognition that it wants to designate or measure or classify its debt investment at fair value through profit or loss. Can decide that if they wish to follow that route. So it's indeed allowed. It's indeed allowed. Okay, so that's what you do at initial um, measurement. And don't forget, there is transaction cost here also. I explained to you earlier on equity that these transaction costs are professional fees for the stockbrokers. They are the stamp duties you pay when you acquire those investments. They are the fees to the exchange that are managing and trading those investments and all of that. So these are transaction costs. So here, the transaction costs will be added to the costs, to the initial costs of the debt investments if it is classified either at amortized costs or fair value through other comprehensive income, whilst it is expensed to profit or loss where it is classified at fair value to P&L, right? So this is this is the treatment of transaction costs. This is the treatment of transaction costs. Now, subsequent measurements for debt investments, which is the measurement at the reporting dates or at the end of the year. How do you do this measurement at the reporting date or the end of the year? So again, this debt investment is subsequently measured either at amortized costs, fair value to OCI, fair value to P&L. I hope somebody will not start asking me, what's the full meaning of this one? Or what's the full meaning of that one? After reading it severally, over and over again. So fair value to OCI that's the FVT OCI, and fair value to POL is this other one. So that's how you would subsequently measure your debt investments. So again, fair value to OCI, fair value to POL is actually very straightforward because it just simply means that they will give you a fair value at the end of the year. And if there is increase in value, if there's increase in that value, it goes to OCI if you are measuring it at fair value to OCI, or it goes to POL if you're measuring at fair value to POL. That's just like that of equity investment. But you see, amortized cost is really what you will find the examiner asking you in these situations. So now, amortized costs. So how do you determine that? What's the value for that? Is so similar to the cost of the instrument, how much you bought it, just that, at the end of the year, for debt investments, you collect interest and all of that. And there could be transaction costs and a lot of other costs that might affect it. So by the time you make those adjustments, then you have your amortized costs. So that's amortized costs. So let me show you practical example. So let's say, let me call this scenario 1. So let's say Wasil PLC purchase a 10 million naira 5% commercial paper from Dangote PLC. Let's say the term is 3 years. Okay, let's do something simple as this. You know that initial measurements will simply be is as good as your debiting your debt investments, okay? Which of debt investment is a financial asset. So you need to classify it properly. You just put 10 million in your books. And of course, you credit bank because you're going to pay, with the same 10 million like that. These initial measurements for you. Now, subsequently, which is at the end of the year, let me see, at the end of each year, that is year 1 to 3, the entity will receive and recognize the annual interests. And how much is this annual interest? So the interest is simply 5% on the nominal value. It's always on the nominal value. That's like 500,000. So at the end of each year, it will be received because this is a debt investment. They pay you at specified date. So anytime you receive money, you simply debit bank, right? And you credit P&L with interest income. With the same 500K. And this you do every year. Year 1, year 2, year 3, right? So in such a way that after the third year, you will have made 1.5 million as income over the third year, which is okay. But every year is 500,000. And at the end of the third year, don't forget that your financial assets in your books is 10 million, your investment. So this 10 million remains your 10 million. Balance carry forward. You are carrying it forward. So it's still there. They will pay you your principal. So you collect how much? Your 10 million naira back. What do you do to that financial assets? You cancel it out. You simply cancel it out. 10 million. So these amortized costs. So the value of this investment every year is amortized cost. That's the 10 million year in, year out. It can be that simple. Then you're recognizing your income every year to P&L, year 1, year 2, year 3, P&L like that. Then at the end of the third year, you liquidate because based on the contract, you're supposed to get back your money at the end of the third year. Now, that's that. That's a very simple one. Let's look at another scenario you can find in the exam, which is scenario 2. So let me simply use the same, I'll just add some variations to it. So let's say Wasu acquires or purchase 10 million, 5% commercial paper from Damgede. The term is 3 years. At repayment, Wasu PLC will get 11 million. They now said the effective interest rate is 8.08%. Okay, so I've added some variations there. And one of the variation is this, that at repayment, which is after 3 years, I'm going to get back 11 million. And they also gave me effective interest rate. So I'm having two rates. This 5%, which is the nominal rate, and now I have effective interest rate. So let's break this down for you. Now, the thing here is this. In this case, Wasi PLC is making two different types of money, two different types of income. Number one, the interest income, the 5% every year. Okay, he's making that 5% every year. Number two, Wasi is also making a premium of 1 million. He's making a premium of 1 million. Just that this premium, he will only get it at maturity, at repayment, which is after the third year, right? And this effective interest rate that they have given to us, why are they giving it to us? The reason is this. Um, it would be very wrong, right, to recognize this extra 1 million that we are making. I mean, this extra 1 million, because at maturity, they will give us 11 million back. So we are making extra 1 million. In addition to the 5%, we are making extra 1 million. It would be wrong to only recognize this extra 1 million at the end of the third year when you collect it. It will be very wrong, because that means that you are then accounting for this transaction like a cash basis approach. We don't use cash basis in reporting, we use accrual basis. And accrual will really require that this 1 million that you're going to make, that you're going to collect at repayment, you should recognize it as income over the 3 years. Because this transaction is for 3 years, this money was indeed made over the 3 years, not a spot. Yes, it will be paid at the end of the third year, but it was actually made. It was earned over the 3 years. So we expect you to recognize it over the 3 years. And that's what effective interest rate is coming to do for us. And this 8.08% means that it has already accumulated the 5% you're making and also the extra 1 million. Now it has converted it to rate for you. Good for you. They will give you that in the exam. In reality, in real life, nobody will give it to you. You have to determine it yourself. But since the examiner will give it to you, I mean, they have made my job easier. So this 8.08% is like now your income. It's like now your global income every year that's encompassed everything, both the nominal interest of 5% that you receive every year and also the premium. So what you recognize as income to P&L won't be 5% anymore. Because yes, you collect 5% in cash every year, but based on accrual basis, the interest you're earning is more than that. It's actually 8.08% because this has also included the premium. So with this now, you would be able to spread the 1 million over 3 years. With this, let me show you how it works, just like the way I showed you the other one. So now we'll say initial measurement. So it's like you're going to debit the financial asset at amortized cost. Okay, you're going to debit the financial asset at amortized cost with the 10 million, and you're going to credit bank with 10 million. This initially, when you made that investment, you simply do this to put dates in your books. Now, at the end of year one, okay, the interest income to be recognized to PLL is 8.08% multiplied by what? By 10 million. So unlike the previous scenario where we recognize the PLL was purely 5%, that's quite understandable because that was the only income we're making. But in this case now, it has to be 8.08 because this has encompassed everything, both the 5% and the premium. If you punch your calculator, then you should be looking at something like 808,000, right? Now, with this 808,000, you're simply going to debit an interest receivable because mark you that you are not receiving this entire 808. Remember, there is a premium element there that you are not going to receive until maturity, right? So what we do is we debit an interest receivable account, and of course you credit your interest income in your POL with the same amount. Okay? 808 in year one. Now, when you do that in year one, the same year one, you will know that the interest received will be 5% times 10 million. That's the interest you receive in cash that they will pay you. They will hand it over to you. That way, I'll take your 5%. You will collect that one fresh. And it's going to be 500K. With this 500K, then you should be looking at, you collect money, debit bank, then you credit interest receivable with that 500K. And why are you crediting interest receivable? Remember, we were expecting 808. Now that we have collected 500, so you can reduce it from 808 to 500. No, you can reduce it by 500. Then that's why we credit it. Of course, that means there will be a balance of 300 there. There will be a balance of 308 in that interest receivable. You see, the balance in the interest receivable will be transferred to the financial asset account. It's just better you transfer it there in such a way that your financial asset balance will now be 10 million plus 308. So you'll be looking at something around 10,308, like this. Around 10,308. That will be the balance in your financial asset account. So this at the end of year one. Any questions? Somebody wants, I saw it and I wanted to finish my listening before. You wanted to ask a question?
Yes. The question I wanted to ask before was that I thought we'll register the 5% for the um instrument separately. Then we'll now use the 8.08% on that 1 million extra that will be paid after the end of the contract. So I think I understood what has been done here.
I think my explanation should have already taken care of that. I already told you that it's the two. It's
Yeah.
just a way of ensuring. I've explained that very, very well. So maybe you're not listening to me or something like that. I already told you that this 8.08% encompasses everything, both the 5% and the premium. It has included the two. So just so that you will not recognize it separately. You are recognizing one income. So you now want to recognize separately again. No, don't do that.
Sir,
Yeah, Michael. Abi? Okay,
it's
Femi.
Femi. Okay, sir. This illustration, this scenario now, I believe is only for when we are classifying the debt amortization costs, or is it if we are classifying it as a fair value through other comprehensive income? Is there going to be any changes, or is this the normal way we still follow?
This is the normal way you always follow. So that's the thing. You will
Uh,
always do
but
this for
but this
all.
one is amortization now, right? All this
Yes,
scenario is amortization. Oh, okay.
yes.
Okay, sir.
So even for fair value through POL or fair value through OCI, you start from here first. You will get your interest because interest will always be calculated for debt investment. You will still do this. So I would inform you of that very soon. Michael,
Yes, sir. Good evening, sir.
yeah, how you doing?
Fine, sir. Sir, I have this question that I want to ask for exam purpose. So, are we to split the interest? You started from the 8.08%, then down to the 5%. So, can we do it like this? Debit interest receivable 308, then debit our what's it called? Our bank for 500, then we credit P&L 808. So is it possible we do it that way?
How did you know? How did you get the 308? How did you know that 308 exists?
Yes, because looking at the 5%, when you deduct it from the 308%, then the remaining percentage, that's the interest receivable.
Why would you want to do that? When they give you exam questions, I'm sure you will always get it wrong at every instance. Don't do that. It's even not correct.
Okay.
This make it
So we have to
express.
follow this. Okay. All right, sir.
Yes. Now, this is just year one. Oh. You do year two, you do year three. See, the good news is this. There's a shortcut for you. There's a shortcut because if you want to go through this in year one, this is pure. This is good. You need to know this as an accounting student. It's pure. It means you understand the logic, the substance, the double entry is good for you. But for your exam, so there's a shortcut for the above entries for your exams. So at every time they will ask you to do this, don't go about doing this. It will take a long time, and some of you are not very good with double entry, and it can be catastrophic. After a lot of stress, you know, made a mistake, that will not be nice. So, I mean, we usually use an amortization schedule for this. And I kind of asked it, of course, we'll solve past questions to attend to all of this. So I kind of asked it severally. So we can use an amortization schedule. So that takes away all these debit and credits and the fears and all of that. So the amortization schedule looks like this. Interest receivable adds interest received, then the balance carry forward. So this one This one at 8.08%. So your Naira, this one at 5%. So your Naira, yeah, the Naira. Okay. So in year one now, the investment was, okay, let me put 10 million. The interest receivable was 808, which is 8.08 times this. The interest received is 500, which is 5% times this. By the time you cumulate these three, you get this same thing very fast without the need for debit credits. And this, you do this in the exam, you get your full mark. You do this, you get your full mark. So you don't have to go through all of this step, but you need to know this. It's important as an accounting student. It's important you know this step. But for your exams, of course, you're free to use amortization schedule and skip all of those debit and credit. So this one has shown you how you enter this debit and credit. This one has shown you how you enter this 500, then the balance, which is 10,000 plus 808 minus 500, gives you this 1038. In year two, you bring forward that 1038. Can somebody do 8.08 times 1038?
Eight 32.8.
832.8. Now,
Yes,
one thing you need to understand is that this one is 500 every year. It's 5% on the nominal value every year. It doesn't change. It's always 5% on principal every year. It must not change. Okay? So, what will then be our balance? This plus this minus this. What will they give us? What will they give us?
332.8.
Sorry?
One 10640.8.
Call figure like an accountant for me, please.
Ten 340.8.
No, that is not how an accountant call figures.
10640.8.
10,000 640. That's how you should be calling. Don't call figure as if you want to collect change. Give me 500 or something like that. You would call it fully 10,640. Also, that's how you should be calling figures in this class. This is an accounting class. So is this correct? Is this 0.8? So in the third year, we have 10,640.8. What's 8.08% times that?
It's 59.77.
859.8. So this is constant. So what do we have?
11,000 11,000.5.
11,000.5. Okay. Now, one thing you should notice is this. The figure at maturity is exactly this 11 million. So this effective interest rate is so powerful that it has gradually increased this 10 million to 11 million. Gradually. That's amortized. It has amortized that interest over, which is accrual basis. So it has recognized that 1 million for you over with this approach. And again, if you look at it, this 5% of 10 million is 500 every year. For 3 years is 1.5. If you add this extra 1 million, it makes 2.5. This one I said goes to P&L every year. If you add the 3, it should give you 2,500. If you add it together, it should give you 2,500. So that goes to show that this 8.08% has really spread the income over 3 years. Like that. Okay, so that's basically that. Any questions? Okay, Ahmed, you have your hands up.
Okay, sir. This 500,000 or 5%. So sometimes in most questions, this interest received 500 as constant. In most questions, I only see it as cash flow. Is it correct when you edit as cash flow?
Yes, now this is what you receive. So if they put it cash flow, fine. Because that's what you received. That's the cash inflow from this amount.
Okay.
What
Okay.
remaining, you know that this remaining, you will not receive this 11 million until maturity. Like that. So it's okay. It's okay. Okay. So this, I think this helps you resolve everything and makes it easy. I kind of asked this severally, so and it's very straightforward. Of course, I will send you some questions as assignments. And probably, if you have sufficient time, we'll solve some of them together like that. Okay. So that's debt investment, and don't forget that um, there is 3 classification. I've majorly talked about amortized cost because this one is straightforward. Fair value through OCI and fair value through PRL. Straightforward in the sense that even if you are using fair value through OCI or fair value through PRL, you will still have to do this schedule. Just that they might then give you a fair value at the end of the year and say the fair value is, let's say, 10.5, for example. Now, instead of 10,308, what goes into your books is 10.5. Why the change, the increase can go to POL if it's fair value to POL, or OCI if it's fair value to OCI. Something like that. And of course, don't forget that what goes to P&L as interest income are these amounts here under this interest receivable. Don't ever forget that. That is what goes to P&L as interest received as interest income in your P&L. While these amounts are the amortized cost or the value of the financial assets that goes to your statement of financial position under your assets at the end of each year. So it could either be current asset or non-current assets. Like in year 1 now, this 10,308 will come in under non-current assets because the amount is due after more than 1 year, so it's still non-current. But in year 2, since the repayment is next year within 1 year, so it can come in as current. 1 year 2, of course, is current when we are going to liquidate this 11 million. And don't forget that the way it is liquidated is that you're going to receive money, so you debit bank and credit the financial asset, like that. Now, I'm done with financial asset valuation or measurements. Now let's go to financial liabilities. How do you measure financial liability? So similar process. So the good news is this: financial liability and debt investment is the same thing. Everything here is the same. So I won't just repeat a lot of things, right? Meaning that the initial measurement here is just that this one is net proceeds. That is transaction price minus your transaction cost. This one is at initial measurement is net proceeds, right? Transaction price minus transaction costs. You know that transaction price will be the amount you collected. Transaction cost will be the money you're paying to stockbrokers, like that. And why is this one being deducted? It's because this one, you are the one collecting money. This is the financial liability. You are the one that is borrowing money. So it's like you borrowed 10 million. The bank or whoever gave you the money, you now have to pay some fees to your stockbroker or whoever. I mean, it will be out of the money you have borrowed. It's just like the practical example is you go to borrow money in the bank, right? The bank will definitely charge you management fees. So if you are borrowing 100 million, they charge you management fees. They'll just hand over the net to you. And you're still going to pay back the 100 million, no? But they will charge you management fee and they give you the net. So what you recognize in your books, in your account, is the net proceeds. Okay? Is the not the money, the gross amount of the borrowing, but the net proceeds, like that. So then the classification, so popularly expect amortized costs. So basically this one amortized costs. Then subsequent measurement also. Amortized cost as well, like that. So it's just the same thing. So let me just use another example. I'll just add a little variation to this one as well. So let's say Wasil purchases. In this case now, since I'm the one borrowing money, it should be Wasil issues a 10 million 5% commercial paper from Dangote PLC. Issues 10 million commercial paper. So this form will not be there anymore. So the term is 3 years. At repayment, Wasil will pay 11 million. Okay, let me add one more thing. Let's say Wasil PLC incurs transaction cost of, let's say, 200K. And I told us that the effective interest, it can't be this again because it will not be more. It should not be 8.85%. So how would this one work? So similar to what we did here, let me just bring the table here. But instead of interest receivable now, it should be interest payable. and also interest paid. So in year one now, the amount you initially recognized, if you put 10 million, you are wrong, because this is a financial liability now, is recognized as net proceeds, which should be the 10 million minus the transaction cost of 200,000. So we should be looking at 98. So can you get 8.08% times 98? Anybody?
Sorry, it's not 0.8%. 8.85.
Thank you, Joy. 8.85% of 9,800.
Six, eight, 867.3.
867.3.
867.3. How about the interest paid? So if you do 5% of 98, of course you are wrong. It should still be 5% on the 10 million. Don't forget, the amount you borrowed is 10 million. Just because you incurred issue costs does not mean you will pay less than less. I mean, it's still going to be on the amount you borrowed. So this is still going to be 500 that you are going to be paying. So what's the balance here? 98 plus 867.3 minus 500. What do we have?
We have 10,167.3.
Okay. 10,167.3. So in year two, you have 10,167.3. So what's 8.85% of that?
899.8.
899.8.
Yeah.
This one will not change. It's 500. What's the balance here?
10,567.1.
So year three, we have 10,567.1. How much would you have here?
935.1.
935 point what?
0.1.
Okay. This will still be a 500. So what's the balance here?
11,000 and 2.2.
Okay, I use approximation.
No. That's 11002.
Okay. So, which is jiving with this 11 million substantially. The two will just be probably approximation, so no issues. So, again, this is still the same thing as what I've taught you. But here now, you will see that when you add these three together, you will get 2,700 because that's the total effective interest this guy is paying, which is the 5% per annum on the one on the 10 million, which is 500 every year, which is like 1.5 million over 3 years. The extra 1 million he will pay, making it 2.5 million, and the extra 200,000 is paying as transaction cost, making it 2.7. So those costs is what this effective interest is helping us spread over the 3 years in order to follow accrual basis of accounting. So, and these are what you will find in your exam. If you know this, it's like 7 marks, 5 marks for you. You're good to go. And that's it for measurements. That's it for measurements. We still have 30 minutes, right? Let me use the remaining 30 minutes to do this one. Then next week, we can solve past questions on this topic. Not next week or tomorrow. I hope we are still on this project together. So let's move on, please. Now, compound financial instruments. This is like going back to IS 32 again. So I'm switching between the two. Compound financial instruments. So first is this. You see, a compound financial instrument is an instrument that has the characteristics of both equity instruments and debt instruments. That's a compound instrument, an instrument that has the characteristics of both equity and debt. And examples of such instruments is convertible instruments or convertible debt. Convertible debts. And these are debts that the holder or investor has a choice of either collecting the principal repayments in cash or shares. That's a convertible debt, meaning that the holder or the investor can decide whether he wants to collect the principal in cash or in shares. So the accounting challenge here is this. So the accounting challenge here is that the issuer, which is our own focus, the person borrowing the money, does not know the decision of the investor. Therefore, he does not know whether to account for the instruments as a financial liability right from the outset or an equity instrument, because we don't know. Because the thing is that based on what I've taught you on presentation of financial instruments, if the issuer knows that he's going to be settling with shares by issuing a fixed amount of ordinary shares, then even though this is a debt, even though he has borrowed money, we are going to treat it as equity because we are going to issue shares to settle it. And if we know that we're going to settle cash with cash, that one is straightforward. We have obligation to deliver cash. That is straightforward. But here now, you don't know. He doesn't know what the investor would do. So we don't know whether we're going to account for it as, therefore, see, in this case, okay, IS 32 requires IS 32 requires that the convertible debt should be treated as both equity instrument and financial liability. So to do this, we will determine the value of the financial liability while taking the equity instrument as the balancing figure. And equity instrument is okay as balancing figure because of what equity instrument is and the definition we have for equity instrument from the conceptual framework. You know, equity instrument is a residual interest in the asset of an entity after deducting all its liabilities. So equity instrument is just fine to be treated as balancing figure because it's always a residual interest after deducting liabilities. So now, how do we do this? I think let's use a question to deal with this. Can I have a question? There's no question. Okay. You know what? Let me pick up a question here. There are two questions here. I'll solve one. I'll give you the second one as assignment. So if you look at this question, it says Ferry Limited issues 4,000 convertible bonds at January 2021. The bonds have a 4-year term and are issued at par with a face value of 2,000 per bond, giving a total proceeds of 8 million. Interest is payable annually in arrears at a nominal annual interest rate of 6%. Each bond is convertible at any time up to maturity into 250 ordinary shares. When the bonds are issued, the prevailing market interest rate for similar debts without conversion option is 9% required. What is the value of the equity components of the bond? I will do much more than this for you so that you can see everything. Now, if you look at this question, this guy issues a convertible bond. That shows me that we are dealing with a compound instrument. It has 4-year term. The face value is 2,000. So he's borrowing 8 million, which obviously is the 2,000 times 4,000. That's the 8 million. The nominal interest rate is 6%, and each bond is convertible at any time up to 250 ordinary shares. This basis of conversion, we don't need it because equity is going to be determined as balancing figure. So it's not like we are going to be converting to equity ourselves, no. So we're now given a market interest rate of 9%, okay? So how do we do this? First is that the sales proceeds or the amounts borrowed, we want to make it simple, use a very simple term, is 8 million. Is 8 million naira. So this 8 million now is what we want to recognize in our books on the date where we borrowed the money, which is January 2021. And the challenge is, should we put it as equity or debt? Now we are saying we should recognize elements of the two. So we need to separate these 8 million. So to do that first, we'll determine the financial liability first, then the balancing figure will be the equity. Now, to determine financial liability, all you need to do is just to get the present value of that financial liability. And how do you do that? First, you would determine the present value of the interests Okay, so this is a 4-year loan. So first, you will determine the present value of the interest. So how much interest are we talking about here? It's around 6% of 8 million. How much would that give us? That should be 480K, what I can see here. Right? So let me just push it forward. Let's say this is the interest. So then the discount factor at 9%. So when you want to do discounting, you have to always use the effective interest rate or the market interest rate. So we need to get the discount factor to discount it to present value, because this interest will be paid over in the future. I mean, we are doing this calculation at the beginning of the year. So we are paying interest for the next 4 years. So what's the value of all that today, right? So you will need to discount it to present value. And since the amount of interest is 480,000 per annum every year from year 1 to 4, so when you want to determine the present value of that, you will use annuity factor. You have to use annuity factor whenever you want to determine present value of annual amount. And annuity factor is determined as 1 minus 1 plus R raised to power minus N divided by R. Okay, so where R is 9% and N is 4 years. Can you punch your calculator and get me the annuity factor? Okay, so I would do 1.09 raised to power minus 4. Okay, I will do 1 minus answer. Then I will do that divided by 0.09. Then that will give me 3.24. So that's 3.24. So if I do 3.24 times, because I can see people don't want to go to your own house. No, I want to go to my own house. So 3.24 multiplied by 480,000, that will be 1,555,200. 1,555,200. So that's the present value of the interest. Also, at maturity, on this financial liability, we are going to pay back the principal. So, which is 8 million at maturity. So how do you get the present value of that, a future amount? How do you get present value of a future amount? You use discount factor, which is different from annuity factor. And that one is straightforward. It's just 1 plus R raised to power minus N. If I punch my calculator with that, I should get 0.708.
08.
If I multiply that by 8 million, if I multiply that by 8 million, I will get 5,667,400. 5,667,400. If I add these two present values together, that gives me the value of my financial liability, which is 5,067,400 plus 1,555,200. It gives me 7,222,600.
Okay.
So the balancing figure will be the equity components. Simply the balancing figure. When we say balancing figure, it means that we'll definitely get this, we'll compare this with the sales proceeds of 8 million. So whatever is remaining,
700,400.
700 and what?
77,400.
And this would represent my equity component. And this is how to separate that 8 million. This working is very important. You do the present value of the interest, you do the present value of the principal, you sum them together. That gives you the value of your financial liability. You remove the sales proceeds to get your equity components. Now, and this is happening at the end of the year. At the beginning of the year, I mean, sorry. You see, at the end of each year, this equity component will not change. It will remain the same. But you see, at the end of each year, for the financial liability, that will change because we use amortized cost. We need to pay interest on it and all of that. So at the end of each year, the financial liability will be measured at what? Amortized costs, normally, like the way we do. So you can use amortization schedule to determine the value at the end of every year. So you can do your years, balance brought forward, interest payable, interest paid, and you do your balance carried forward. So the interest rate here is the effective interest rates. This is the nominal and your value. So in the first year, which is year 1, the value of the financial liability was 7,222,600, which is this. This 7,222,600. So can you do 9% of that for me? What's 9% of 7,222,600?
650,034 naira.
This one does not change. It remains 480,000, which is 6% on the principal amount, 6% of 8 million. That's the amount you would actually pay every year as interest. So what will be the balance?
7,392,634.
So if you continue year 2, year 3, year 4, you will discover that at the end of year 4, the balance will be 8 million. So I will not want to start doing all of that. What I want to show you is if you now want to prepare your statements, let's say statement of profit or loss. Let's say for the year ended the first year. So you have interest paid in your P&L as 850,034. This one goes to your P&L. And also in your statement of financial position as at year ended, under your non-current liabilities, you have this convertible debt as 7,392,634, which is this balance here. And under your equity, you have your equity component of the amount as 777,400. And that's all. That's the beginning to the end. I've done more than what they ask us to do. What this question asks you to do is to end here, to just get this. Okay, so I've just shown you everything from the beginning to the end in case they ask you to prepare account. So after you have done this, you need to be able to get the value of the liability at the end of the year, what goes to POL, what goes to your statement of financial position, and all of that. So you have the entire system. Okay, now you can ask questions. I think I'm done. So I think Omolola should go first,
Yes.
but I saw her hand first, before you. If Omolola is still interested in asking, you
Thank
can
you,
go
sir.
ahead. Okay.
I'm here, sir. So I want to get the figure for the minus hand, risk per minus hand. I didn't know how you arrived at that.
The raised to power -4.
No, minus hand. The yeah, what was imputed in the formula?
See this one?
Yes, sir.
That's the formula now. Raised,
Like I mean
raised to power
the
-4.
yes. Okay, so it's risk per minus 4.
Yes.
Oh, okay,
Is
sir.
raised to power -4. That's the formula.
Okay, what of this 1 to 4? If I had to do this from year 1 to year 4, because I was trying to punch it in my calculator and I was not getting it. I was like,
Okay, you are not getting this one, Abby.
yes, sir.
Okay, so what you're supposed to do is you will do 1.09, which is you do 1.09, which is this 1 plus half. If you know how to press raised to power on your calculator, you do raised to power 4. Okay, which you do raised to power 4. Then you press equal to. You press equal to. Then you then do 1 minus answer. You do 1 minus, there's a button called answer.
Okay, sir.
Whatever you get, you do equals to. Then you now do divided by 0.09.
Okay, sir.
Are you getting it
Thank
or
you,
you're
sir.
not getting it? Okay.
I'm getting it, sir.
Okay. So the next person, Femi, go ahead with your question, please.
Thank you, sir. I wanted to reconfirm this figure. Sorry, please. This yes, this 850,000 850,004. Yes. How do we arrive that one? I think.
Is 9% of this, of the opening value.
Okay, then it should be 650,034. Okay, thank
Okay.
you, sir.
Thank you very much. So that means this is wrong then. Can you help us calculate this?
Okay.
Who is doing that for us?
892634. 892634.
You're giving wrong figure.
It's
This
wrong.
plus this minus this.
That's what. Okay. Oh yeah. I think I wanted something. Okay, 739.
Call figure like an accountant. 7 million.
Okay, 7,392,634.
Like this.
634. Yes, sir.
So again, I think Adiola is asking from the last solution, the amount going to PLL. Okay, so I told you that is the interest payable that goes to PLL. Okay, so which is this 650, not the interest paid, is the interest payable, this one. That's what you find in your P&L. The same thing in all the other ones that we have actually done, like that. Okay, so I will share these working notes with you. You're supposed to solve this second. It's similar to what I've just solved. Supposed to solve these as assignments and submit before tomorrow. So, and if you can try your hands on all of this, you'll be doing yourself a great good. But if we cannot, no voila, we'll take our time I'll solve it with you guys, then also solve some other past questions. But ideally tomorrow, we should be ending this topic today. I'm actually done with this topic. So I can just for 1 hour, I can just solve past question with you guys tomorrow. Then we'll start IS 36, impairment of assets. IS 36, I'll start that with you tomorrow. Hopefully, we'll finish it as fast as possible so that we can move to IFRS 15 and like that. We'll just be moving. But for this month, we need to cover a whole lot this month, especially standards. So that in September, first 3 weeks in September, we can take out group accounts then so that later in September, what we'll have left to be just few standards and maybe ratio and EPS, then so that we can have the whole of October to solve past questions, as many past questions, statement of cash flows, sustainability, all of those, a lot of things. And also, I know that you guys have free periods tomorrow. I know you don't have any classes on Sunday from morning till evening. I know you're free. So in August, this month, we're going to start using it. We're going to start using it so that we can go very far this month. It will help you so that we'll be able to finish our syllabus by September. It will help you greatly. So when I say, oh, yeah, I'll come, we'll better come so that we can move very fast. Okay, so thank you very much. I'll see you tomorrow. Bye.
Thank you.